Hi, I'm Steve Van Metre, Certified Financial Planner, and this is the Employer-Sponsored Plans and IRAs section of the Boomer Retirement Planning class. Before we begin, I do have to read some disclosures. Advisory services are offered by Atlas Financial Advisors, Inc., a registered investment advisory firm. The information provided in this class is for educational purposes only, and prior to acting on any material, you are encouraged to seek qualified tax, financial, or legal advice as it pertains to your situation. Employer-sponsored plans and individual retirement accounts. Let's begin. Some common questions that come up in this section are: what is an employer-sponsored plan? What is a traditional IRA? How and when can I take withdrawals? And how can I roll over my money into a traditional IRA? An employer-sponsored plan is a pre-tax retirement account that is sponsored by your employer. The money grows tax-deferred and is taxed as normal income when withdrawn. Can only be funded by payroll deduction, employer matching funds, or from profit sharing. An IRA or individual retirement account is a pre-tax account just like your employer-sponsored plan. The money inside it grows tax-deferred and is taxed as normal income when withdrawn. Can only be funded by a direct contribution or rollover. Contributions can now be made at any age as long as you have earned income. When it comes to withdrawals and distributions from employer-sponsored plans, if you're over the age of 59 and a half, then there are no penalties for withdrawals. If prior to the age of 59 and a half, then a 10% early withdrawal penalty will be incurred unless you have a penalty exception. You may be required to get prior approval before taking withdrawal and may be limited to a number of distributions per month or per year. There's also a 20% mandatory federal tax withholding on all employer plan withdrawals. With IRAs, the rules are fairly similar. If after the age of 59 and a half, there are no penalties for withdrawals. If prior to the age of 59 and a half, then a 10% federal early withdrawal penalty may apply unless a penalty exception applies, such as a 72T. You do not need prior approval, and there are no mandatory tax withholdings from IRAs. An exception to the 10% early withdrawal penalty is the 72T, and this allows for distributions to begin from an IRA at any age and to avoid the 10% early withdrawal penalty. The distributions must be substantially equal payments and must last until the age of 59 and a half or for 5 years, whichever is longer. Some disadvantages to a 72T is you cannot split accounts once formed. So if you want to move from one investment to another with part of your money, you will need to move all of it. There are penalties if the distributions are not completed, and losses are highly problematic. You can split accounts before forming an IRA under a Section 72T. This will help you avoid the big pitfall if you want to move some of your money around to be invested in different ways. And you may also want to consider annuitizing within an IRA, such as a period certain, which we cover in the third week's material. After the age of 72 and a half, you must begin your required minimum distributions. The amount is calculated from the December 31st account value from the prior year using the IRS's Uniform Lifetime Table. The distribution starts at about 3.65% of the total balance of all pre-tax retirement accounts. The percentage you must draw increases annually. You must take the first required minimum distribution in the year you turn 70 and a half, although you may postpone your first distribution until April 1st of the following year, and it depends on if you were born in the first half or second half of the year. After the first year, the deadline moves to December 31st of each year thereafter. Failure to take your RMD would encumber a 50% penalty to the IRS on top of income taxes on the entire distribution. When it comes to investments in employer-sponsored plans, you're limited to the investment options offered by your plan. When it comes to IRAs, almost any investment can be purchased inside of a traditional IRA. You can roll an unlimited amount into an IRA upon separation of service, age 59 and a half, although this may not include employer matching funds, death, disability, financial hardship, and plan termination. You can roll an unlimited amount of any age into an IRA from an existing traditional IRA, a simple IRA after you've owned it for 2 years, a SEP IRA, 457B, qualified pre-tax plan, 401k, and pre-tax 403B plan. And this concludes the employer-sponsored plans and IRA section of the Boomer Retirement Planning class.